Hello, and welcome to this episode of Insufferable Experts. We are the three people you'd least like to meet at a party: David the lawyer, Kaylin the tech founder, and Tyler the technologist. This week, we're going to talk about a quote that caught our eye from a VC. It's Rebecca Lynn from Canvas Ventures. It's from an interview in Fortune magazine. So what she says is, never be a first mover. First movers bear the burden of proving that a market exists. You're paying to get consumer awareness of that market. You're fighting this uphill battle. You're spending a ton of money to prove out the market, and by the time you finally prove it exists, you have an aging tech stack. Why not let someone else break that? You watch where the puck is going and then come in with a better product. So the big question that we have to ask here is based on first mover advantage, because she's basically saying, if you are the first mover, you're actually the loser. So I wanted to throw this out to Kaylin because we had this conversation about all of this, and I know you have a lot to say. So give us your point of view on first mover advantage and some of the comments that she said as a VC.
Yeah, I think that, my first thought is venture investment is meant to be risky. The reason your returns are anticipated to be so far outpacing regular, high yield savings account, mutual funds, S&P indexes, the reason that you anticipate higher returns is because you accept higher risk. I want to lay that baseline because I don't think she's inherently incorrect about making a strategic play. It is very dangerous to be the first mover. It's incredibly difficult to do all of the education surrounding why this market is emerging, why your solution is better than what's currently in the landscape. That takes a lot more than just a good product. It takes a lot more than just a good team. There are so many factors at play that I can appreciate. The outsized risk is one that most people don't have an appetite for. However, in venture capital, that is quite literally your job, is to find these really, really niche wedges and see how you can blow it up. And the catalyst capital, as I'll call it, is not funding a chain of established businesses. There's a reason that you make the big bucks or you anticipate the returns. And I will also say that constructing a portfolio, as far as venture capitalists are concerned, largely revolves around the understanding that most businesses will, in fact, fail. And that's the reason they put such pressure on early stage companies to continue raising at higher valuations, to continue generating, I won't say profits because almost no venture backed company is profitable for so long, but they're increasing their margins, they're increasing their scale, they're increasing their reach, and they're putting so much pressure on increasing valuation for the sheer fact of the matter that most of their portcos are not going to make it. So the big home runs are so important. But how are you really constructing a play for home runs if you're not seeking singles, doubles, and triples? If you are really looking for home runs, I don't think you can do that without making new markets. You have to be a market maker. You have to be an industry creator. You have to be a category creator in order to. Uber is a great example. I mean, there are tons and tons of examples, but there are so many companies that only became as big as they became because they created their own category. And I can appreciate the danger that is associated with that. But to me, venture capitalists, that is your job, and you play the rest of the field accordingly because you say no to companies who have very viable businesses because they're not going to return a sufficient multiple, right? So if you're looking for the multiples, the riches are in the niches, right? Like that's where you've got to look and you've got to take that risk. To me, that's what justifies your outsized returns.
So this is based on something Kaylin has said about the hitting runs. And my way of thinking about it is that it's a shame that there aren't two models of venture capital firms. And because there basically needs to be. You need to have either one, companies, venture firms that are structured on hitting a grand slam. And it's called a grand slam or a royal flush or whatever other analogy you want to use because it's super rare. That's the point. It's worth a bunch of points or money or whatever you want to call it because of how rare it is. So you should set up your entire firm assuming that 95% of your businesses are going to fail. And those 5% are going to make up for the other 95%. That's the inherent nature of the thing. It's high risk, high reward. So if you're setting up your firm to do that, set up your firm to do that. It exists in all sorts of areas. There are law firms that are set up that way too. And some of them fail and some of them are spectacularly successful. And then you've got the other side, which doesn't really exist and should, is venture firms that aren't trying to hit grand slams. Instead, what they're trying to hit is singles and doubles. Mm-hmm. And so they're looking for companies that can hit that 5x or that 7x in like 3 or 4 years. And that way, it doesn't matter if they don't get any grand slams. They're going to have a much higher rate of return. It's much more likely that only quote unquote 30 to 40% of their companies are going to fail rather than 95%. And that way they can still make just as much profit. And it's lower risk, lower reward. They're still both making a bunch of money, but it's, are you a gambler or not? I mean, I generally am sort of a gambler, but not that much. So if I were a VC, would go with the singles and doubles strategy, which is perfectly viable.
Or you'd have a lot more red meat out there as well, because I think that the pattern matching has gotten so egregious.
Exactly.
Looking to say, well, Uber did it this way. Are you following suit? Well, Uber did it how they did it, and that's what made them different. The next Uber, whether it's in that industry or otherwise, is not going to do it the same way. However, it's sort of gotten into this reductionism where you look for pattern matching in order to try to predict the future. If you're a gambler, you're looking for signals and patterns and trying very hard to process them and internalize them so that you can make your most informed choice. But the one thing we know about most unicorns is they didn't follow any other pattern. So problematically, when you are trying to find the next unicorn by looking at what an old unicorn did, you're screwed.
Yep. And I want to say, like, I can see both sides of the argument when talking about first and second, because, like, I think the most famous and the most successful second mover is Meta, Facebook, right? There was Friendster, there was MySpace, and they kind of paved the way for that generation to do it. And then Facebook came in for whatever reason, executed better. I don't know what really it is. But then, like you said, Caitlin, there's Airbnb, there's Uber, right? And those are the ones where it's like, no, like, they're the first mover and they have never looked back. They have never looked back. And the question you have to ask yourself is, which is the more likely thing to happen? And I believe in category creation, because what you do is you are raising awareness of a problem that no one has either thought about or realized they had. And surprise, I already have the solution ready to go for you. So by that virtue, you can really get a huge head start. But there are many, many examples of category creating companies that also didn't operate in a way that maintained their advantage. They didn't establish a brand. They didn't do a good enough job at keeping people aware. And some scrappy competitor could come and literally create a copycat and do it. So that's where I see there could be both sides of these equation. It sounds like she's taking the latter, where she's like, I'm going to look for people that have created a category but are not doing well and find that scrappy competitor or challenger that could actually.
I think that's a thesis to find. That's sort of like David's two tracks. If you have home run vision versus singles and doubles vision, and you'd rather get a greater percentage of a lower return that probably yields you more in the long run, but that's not the issue, versus the home runs. What I see happening, for instance, I think that what you're talking about is like, well, then create a challenger thesis. I don't know. That's what you believe. Then I wouldn't write it off as this is how the industry should go. It's more about that's your vision, that's your thesis. I'll tell you what, I see around New York, Citi Bike has its territory getting encroached upon, right? There are some orange bicycles and some green bicycles that are coming up and cropping up. And you know what Citi Bike has done is like they took for granted the fact that they had first mover advantage. They have the scale, they have the network, they have the infrastructure and the hardware. They've got all of that laid out. But what are they continuing to do? Increase the costs, throttle the speed. Now, when I take an e-bike, I have to choose, do I want partial assist or full assist, because they're going to charge me more for it. It is so infuriating every single time, but I've become so reliant on the notion. I don't care about Citi Bike as a brand. I do care about its utility. So the minute another challenger brand comes in and says, we'll do it for cheaper, or we won't throttle your speeds, I'm going to go with that. That's a great business prospect. That's a really good attack vector, but it is one pathway. Somebody had to fund Citi Bike and made a shit ton of money on it. But there is still money to be made with the challenger brands. I think two things can be true. And that is not the statement in the article to me was this universal thesis of what venture should look like, or how venture capitalists should be operating or thinking about their portfolio. And I largely obviously disagree, but these are all vectors within an approach. And I think then start defining your thesis better, start defining your thesis differently. And then people will know who to approach instead of getting rejected because, you just didn't think that you wanted to spend the time on the education, the scaling, the traction.
Mm-hmm.
Yeah. So a couple of things. One, so I was listening to a podcast called Acquired yesterday, which does these long form histories of companies. We're talking like 2 to 3 hours, and they do in-depth research and go through a really famous company's whole history. And the reason I mention this is that part of being a VC is having vision. So they were talking about, on this particular episode, Porsche. So in the 90s, Porsche was a train wreck for a variety of reasons. Their market cap for Porsche was like $400 million, which was nothing, right? And at that point, literally everyone thought they were going to go broke, or that somebody else was going to have to buy them, or something like that. And then they had a new CEO come in who turned out to be a visionary after the previous like 4 or 5 CEOs were a mess. And within 10 years, their market cap had gone from 400 million to 32 billion.
Mm-hmm.
If you had invested in Porsche in the 90s, when it was at that 400 million cap, you would have made like 1,000x return or something insane like that. But as they said on the podcast, and they're right, no one in their right mind would have invested in Porsche at that point because everyone thought they were going to go broke.
Right.
But if you were a visionary VC who could see, oh, this is an established brand that's always been the first mover, and they're going to continue being the first mover, they just need better management, you would have made a killing. Like Uber levels of money, like investing in Uber at the beginning levels of money. So I think that's the other thing. Do you want to invest in vision or not? I was talking to somebody yesterday who was saying that one of the inspiring things about entrepreneurs is that they have the vision to bet on themselves and to bet on their abilities, right? And that's essentially what a VC is doing. Do I have the vision to correctly pick good companies? Basically, you're betting on yourself.
Mm-hmm.
Can I predict these people? Yes,
Okay.
Caitlin?
This is where I think pattern matching gets ugly.
Mm-hmm.
Because of all of the VCs I have met, which is not all of them. So,
Of course not. There are 10 million.
Of course. But from, I would say, a significant number of data points, the vast majority of them are pattern matching. Again, not even from a business perspective, but from a people perspective, right? Where they are saying your pedigree has become a predictor of success. Your, whether it's your schooling, your prior jobs, your network, et cetera, et cetera, et cetera. There is no greater false signal. And this is studied relentlessly. That's not to say people who went to Harvard are not smart. Of course they are. However, the overvaluing that we as a society place on somebody's pedigree is no real indicator of how hard they will work. And those things can be very different. I have not seen, and I would love for a VC to raise their hand and tell me this is how I do it, but I would love to see a VC that only invests in ultra marathoners. or some other indicator that shows me, well, what you're going to have to do is shove your head into a brick wall every single day, eat nose for breakfast, and have relentless pursuit and the endurance to make it through. So you know what my thesis is, that ultra runners have that. I don't know what it is, but like we have such old tropes and such like out of date tropes of what signals or predicts success, that I also think that, David, it's optimistic and in fact altruistic to think that VCs are betting on their own ability to pick champions. But I don't think they're doing that. I don't see evidence of people with unique theses, because especially at early stage, you are betting on founders. You are betting on their personality, on their resilience, on their endurance, on all kinds of things, right? Their charisma, their ability to take a product to market. Some people can sell ice to an ice Eskimo, but others cannot. And like, I don't really see, and even when I was a practicing attorney repping lots and lots of VC firms, like they couldn't really articulate the why of why they picked somebody other than reading me their resume. And I don't think that that's a great predictor. And in fact, portfolios show us that that's not a great
Yeah,
predictor.
totally.
Go ahead, Ty.
I was gonna say that some of it that's crept into this industry, like the VC industry before, was a lot of what we've been espousing, which is like we're looking at category creation. We're generally bringing new things into the world. Like it's that whole Silicon Valley ethos of like we're bringing the net new best thing, right? And VC now is a lot more of, it's a mature industry. The pattern matching you talk about, they're more risk averse. And like it's all about creating a strong portfolio and not really like influencing massive change. It's more systematic and less like evangelist driven. And like I get it, LPs, everything, you have to be able to report back, but like it's turning more and more like traditional finance rather than what it was, which was out on the boundary, bleeding edge, really trying to get that vision and see ahead and have a competitive advantage doing it, because you're going into the spaces that most people don't go. You're going into a place where it's early stage can be more qualitative than it can be quantitative, right? And I think if I bring a corollary back to the public markets, like there's always an axiom where like the second you see the thing happen, the opportunity is already gone.
Too late.
Earnings comes out and it goes up 20%. Don't you dare go and buy that. Don't do it. You're going to get burned. But if you dug in and like, you know, the people that have literal satellite photos that can look at parking lot demand over the course of a quarter to determine whether or not Walmart,
that I like it.
yeah, like to determine whether or not Walmart is like has like same store sales go up, like that is the thing, that there's that vision or that creativity or that somewhere where you can get a competitive advantage. And I think that a lot of that is being lost right now, because as I've seen it, and again, like you, Kaylin, you were in this world before I was, but even I can look back and hear people talk about it. Like it's become almost a mature industry in the sense that like where it used to be 20 years ago, they were like a couple VCs and everyone knew their names and like that's kind of what the vibes were. And then it turned into this incubator and that incubator and this person and that person, because people exited these large tech companies and are like, I got all this money, let's be an angel investor, let's turn into VC. And I don't blame them for it, right? But I do think that it's taken this industry from what it was, which was an actual facet of being on that bleeding edge on behalf of American society and entrepreneurship. And it's turned more into like a private equity firm than it is a venture firm, which technically is private equity, but you get where I'm going with this.
Before Kaylin jumps in, I have something I want to say, and I know Kaylin will have things to say too. I was thinking about what you're saying, and you're totally right. And I think this is a perfect example for why all three of us get out of the bed in the morning. So anytime an industry becomes like overly mature, right? And has started to turn into something that it wasn't intended to be, somebody else is going to come up behind them. At least this is the great thing about American society. Somebody else is going to come up behind them and say, oh, you were trying to do this, but you're not doing that anymore. Let me do it. It's a great idea. It totally works. Let me do it. Right? And so like with MAGNETIQ, we've talked about how social media is broken. Right? It doesn't work anymore. The idea there still makes sense and there's still demand and a market for it, but it doesn't work. So MAGNETIQ, far be it for me to talk about your company, but it's from my perspective, MAGNETIQ is saying, oh, you're not doing this anymore? Great, I'm going to do it for you. Right? And I have the exact same perspective on the law. lawyers are supposed to be, at least some of them are supposed to be those revolutionaries, finding those new areas and helping to find new ideas and new things. But a lot of the big law firms have gotten boring and said, okay, well, we're just going to represent the same kinds of companies over and over and over again and charge X dollars and give you the same boring product and et cetera, right? And me, as a lawyer who wants to support that American dream and make the country better and be a visionary, has seen, wait, there are lawyers who aren't supporting these visionaries, and they're going to get trampled if they're not careful. I want to make sure those visionaries are ready and prepared for their legal stuff when it goes wrong, so they can become Uber or Spotify or something like that. That is why I started my own law firm. And I predict that in 5 to 10 to 15 years, we're going to see financiers and other kinds of people with money and backing create VC firms that go back to that original idea of being on the leading edge.
I don't know. I think that the industry writ large has diluted itself, because I can tell you that every other man on a dating app says that he is a venture capitalist. And what that means is he took $5K out of his inheritance and like threw it in his 3 initials, comma LLC, and called it a day. So, but there is this erosion of trust on both sides. I'm not saying that it should have stayed an ivory tower industry. I do not support that conceptually at all. But I do think that there is a lot of skepticism on both sides about how serious people are, because A, the barriers are lower than ever to start your own company. And B, the barriers are lower than ever to start your own fund. You can get form docs from anywhere, set your entity up, and call yourself the CEO of JRK LLC or JRK LP or whatever it is, right? And the problem then becomes everyone is skeptical of the other, because I can't tell you how many not serious people we meet with. And they are either not deploying capital, just trying to pad their roster, collecting intel for portcos of somebody else's, or they're a scout. Like, there is a lot that goes on that means I also, as a business owner, do not trust about the venture capital space. And that's just through pure experience. That's not reading about the issue. That is quite literally, our time has been wasted so frequently. And so you're actually refunneling a lot of deals back into the same old trenches. I don't think that's necessarily the best pathway either, but okay, great. A16Z, Sequoia, General Catalyst, like RRE, all these, Khosla, great venture funds are still the beacons in the industry, whether or not they are experts in that field, but more because they have some baseline of trust and they have some brand equity that you're not getting sort of like funneled into a shit show, honestly, with somebody who will waste your time. So I do think that actually volume is reconcentrating in a way that almost re-centralizes the whole process, but it's not for great reason. And so I think I'm curious to see how the landscape will continue to shift as barriers to entry only continue to decline. And everybody can say they're an entrepreneur and everybody can say that they're a VC. And now you spend half your time trying to sort and filter for who's an honest, serious person before you start to go down this pathway. And I think that that's created more friction rather than less. So I'm curious to see the evolution as we continue to develop both sides of the equation.
Yeah, and I think to your point about things being more accessible than ever, I also think, and this is an entire other episode that I think we'll get to, but what are you using capital on early stage in a company now? Because we have had a lot of really big advancements that have happened over the last 3 years. It's 2 letters that everyone knows, But there are really meaningful ways that you can do it now. You can code an app by just typing into stuff right now. You can create an MVP from nothing, right? And start to get in front of a customer and start talking to them about it. And it can all come from your brain. You don't have to pay someone to put your vision together. The same with like go to market, the same with a bunch of other things, which is why it could be its own episode. But the point is, if you really break down the buckets of what most early stage companies use that money for, the question becomes, are you raising the money so you have the money? Or are you raising the money so you have the brand and the backing that you are a venture backed company, right? So what is the utility and the value that's coming up? And I think that that could also determine where the future of the industry becomes as well, because sometimes you raise from a certain fund or you get venture funding. Caitlin, you and I run into it all the time. What's a question sometimes people ask? Are you guys venture funded? Because it tells you two things. One, you'll have money to partner with me and buy said product that we're talking about, or there's a chance you have it. And two, it means that you've gotten some outside validation from someone who allegedly is looking at all of these things in it with a methodology, hundreds and thousands of them every
It's
single
social
day. And
proof.
so I
You're
think like
basically
this social proof,
shortcutting.
yeah,
It's
yeah,
shortcutting to validation, as you said, but the social proof, I think, has become so much more important. Instead of,
hmm
but I think that's a shortcut, which I'm not shitting on it, but it is a shortcut because instead of doing your own diligence and saying, I like this person, I like this idea, I think it could work, the shortcut is who else believes in this?
correct. Yep.
Who that I trust has believed in this first. So it's the same way that people lead rounds, right? All the follow-on investors, nobody does diligence because they're just like, A16's
Be a
easy.
second mover investor, literally. Someone
Literally.
else makes the
But
first
they're just
move.
kind of like, okay, well, you guys must have it figured out. But that's the same reason that people look for, well, what brands, we see this, people do this on LinkedIn all the time. They have their like X Meta, X this, X that, X Nvidia. And you're like, I
Mhm.
don't care, man. But what is that? It's a shortcut to social proof, which is a shortcut to trust. And people are like, well, I trust McKinsey because I'm not sure why, because y'all put like 21-year-olds in charge of saying, have you ever thought of reducing your
Raising
overhead?
revenue.
Raising revenue, right? Like McKinsey, piss off. Um, so I think that the same concept though is like, well, you went through some vetting process to get there. You had to go to a good school. You had to get a certain grade on your like exams, and then it's a short signal for a lot of other things, like I was talking about earlier, that I think are outdated markers and proxies for success, for who's going to be successful. I want to know, like, how much trauma did you heal yourself from? How many ultra marathons have you run? Like, talk to me about how you've used your free will to do things that are uncomfortable. That's my proxy
Mhm.
for,
Mhm.
are you going to be a good entrepreneur, right? And I'm not saying I've got the whole key unlocked. I think we all would love to think that we have all the answers. We do not, but it is incredibly frustrating to see the same playbooks leveraged over and over and over as the world is changing so drastically. Harvard is no longer the singular
Mhm.
institution that represents pedigree, right? So, for all of those reasons, like in a small nutshell, that one tiny example to me is emblematic of what is wrong, where we're all trying to borrow trust. We're all overloaded. We're all super, super busy. So nobody wants to go do a deep dive. But like, you miss out, I think, largely on the really big opportunities by pattern matching to the medium opportunities.
Okay, so a couple of things. One, so I want to make a comment about what you were saying about pedigrees and universities. There are two ways to do that, sort of, that I see to solve that problem. You have the Costco method, where Costco was a first mover, and they have heavily emphasized promoting from inside the corporation, which proves you can do it. Interestingly, their current CEO went to San Diego State University, which is a fine school, but doesn't have the reputation of Harvard, right? And I think like maybe one or two of the members of their board went to an Ivy, and that's it. All the rest of them got a normal, quote unquote, normal education and proved themselves at the company over the course of like 30 years. That's one way to do it, which is totally legitimate. And look, Costco. I mean, everybody's heard in the US has heard of Costco. It's a massive company. And then secondarily, Fun side note about Costco. The market cap of just their Kirkland signature brand is bigger than Nike. The Nike's
They do
entire
not
company.
release anything under the Kirkland banner unless it is an industry leader. So you think you're getting discount denim, steaks, like you name it. They do not put the Kirkland name on it unless it's an industry, unless it beats industry metrics, which is incredible. And like the brand perception that, I know this is a little bit of a derailment, but the perception that people have of it being store brand of anything is wild, because everything from their wine, you may not like their wine, you may not like their steak, you may not like their denim, but they are relentless about measuring it against the competitors in the landscape. So they're actually, this is why people end up trusting it and loving it. That and the fact that they won't raise the hot dog prices, which
Costco is an incredible corporation for any number of reasons. That included most of it having to do with how they do their funding and a bunch of things. There was literally a 3-hour episode of Acquired about why Costco is amazing. So I'm not going to go into that. But the other thing is what Kaylin and I were saying at the beginning, and tying back to that about how, are you trying to pattern match and are you just using a random metric? Then what you're going to end up with is crumbs. You're not going to end up with 1000x if you're trying to get somebody else to prove to you that it already works. That's why you're getting that 1000x in the first place, because you took the gamble that it's going to work. No one's going to give you 1000x for something that somebody else has already proven works. Why would they? That just doesn't make sense. So either do the current Costco model, not Costco when it started, which was totally in the other camp, of like singles and doubles, and fine, maybe rely on some pattern matching. But just know you're going to get 5x, 7x, something like that. And be okay with that. Set up your company to do that. Or set up your company in the other direction and assume that 95% of it's going to fail, but have confidence that you're good enough at your job that you're going to at least hit that 5% that's going to hit the grand slam.
Totally.
Which
yeah,
is
I've been trying to straddle both. Is like, tell me you're not good at your job without telling me.
Exactly,
and
right?
It's trying to keep a foot in each lane.
Trying to do two inherently contradictory things at the same time is just a recipe for disaster, which is why we fully disagree, for the most part, with that quote. Okay, so we hope you've enjoyed that discussion. Thank you for watching this week's episode of Insufferable Experts, and we will see you back here next week for more very strong opinions about lots of things.
Strong opinions.
Please don't forget to subscribe, like, follow,
share.
We're on YouTube, we're on Apple, we're on Spotify, we're on Instagram. And yeah, just like David said, we'll see you next week.